What's going on, guys? Welcome back to the channel. My name is Mark and this is Entrepreneurial Finance. So first things first, I shaved my head. I'm going crazy in quarantine. Have you done anything with your hair? Let me know in the comments below. So these videos take a long time to make, and a simple like or subscribe on the video would go a long way, and it is greatly appreciated. So with the stock market coming down from all-time highs from simply a month ago, I'm sure a lot of you guys are wondering,
have we hit the bottom yet?
Now, like anybody in the financial industry, I'm going to preach what they should be preaching to you. Investing is not about calling the bottom nor timing the market. Investing is about managing your risk. If you want to invest based on speculation, you should only risk money which you're willing to lose. Now that we got that disclaimer out of the way, let's go ahead and jump into today's video. So the IMF recently stated that the coronavirus is going to cause the greatest economic slump since the Great Depression. Now that's great. A lot of us probably already know that. Okay, the real question is, how is the stock market going to react to it? Once we get GDP numbers, retail sales, industrial output, CPI, as well as unemployment for the next quarter, how is the stock market going to value where it's currently sitting? It's currently trading about 30 to 35% below their all-time highs that we hit in about mid-February. So are we going to continue going down, or is there actually some room to improve here and we should see stocks rebounding in the near future? We have businesses literally going from operating at 100% to somewhere between 25 to 0%. You have revenue going from up here basically down to zero instantly. Okay, so 30-35%, does that justify how much of the economy is shut down right now? Probably not, but we don't know for sure. Before we answer that question, let's quickly define what a recession is and the difference between a recession and a depression. A recession is defined as a macroeconomic indicator typically defined by two consecutive quarters of negative economic growth, usually defined by GDP. The most recent recession we had was in 2007 through 2009, during the subprime mortgage crisis in the US. Now, the difference between a recession and a depression is pretty important here, because a depression is usually defined as a prolonged period of negative economic growth, typically 3 years or more. You have a recession, which is two consecutive negative quarters of slumping economic growth, whereas a depression is usually 3 or more years of slumping economic growth, which is much different. Probably the most familiar depression to everybody is the 1929 through 1933 Great Depression after the First World War. You know, we saw like crazy unemployment numbers. You had most of the world recovering from the World War. We were kind of in unprecedented times, and then of course right after that was the Second World War. But anyways, the most familiar depression to everybody typically is that economic slump which we saw right after World War I. Okay, so why does the IMF, or the International Monetary Fund, believe that another depression is on the way? We have them stating here that it's heavily dependent on the duration of this pandemic, or lockdown if you will. So governments actually have the lion's share of the power here. So here in North America, you kind of have two polar opposites between Canada and the US, in my opinion at least. You have Justin Trudeau, the Prime Minister of Canada, who is very content with keeping the country locked down as long as possible, which in most medical professionals' opinion, as well as my opinion, is the right thing to do. Now, south of the border in the US, you have President Trump, who is kind of the opposite, okay? So he believes his status in the polls is dependent on his economy or his stock market. While he's been in power, we've seen one of the greatest bull runs in history, and he wants to continue that all the way up to the election in November, okay? So he wants to open up the US as soon as possible, and he is reviewing the possibility of opening it up after Easter. Besides North America, you also have most of the Eurozone shut down. If you just look at some of the infection rates worldwide here, you can see Europe was kind of hit the hardest before we saw the US kind of take over in terms of leading in number of infections. Now, just a couple stats for you guys here. So the International Labor Organization, or the ILO, estimates that 1.25 billion people are at risk to drastic pay cuts or layoffs in the near future here. The United Nations estimates that this pandemic will send about 500 million people into poverty worldwide. And then you have the World Trade Organization expecting a drop in global trade somewhere between 12 to 32% in 2020. To put this all into perspective, like the IMF said, they're expecting another depression on its way. If we look at the Great Depression of 1929 through 1933, we saw GDP declines of almost 26.7%, okay? If we look at 2007 through 2009, the worst GDP decline we saw was 5.1%. We're saying that this next economic slump is going to be about 5 times worse than what we saw in the financial crisis, according to the IMF. There's a lot of questions right now, but I believe it all kind of points to one direction and one eventual outcome.
A global debt crisis.
So in the 21st century, no government actually borrows money expecting to pay the full sum. They simply assume that when their liabilities are coming due, that they can just borrow from somebody else to pay down their debts. The combination of economic downturns, capital flight, political instability, and collapsing commodity prices may make it difficult for some countries to refinance their debts. So here's a list of countries with the highest debt to GDP ratio, and these countries will ultimately have the hardest time paying down their debts when this comes to fruition, okay? So you have Japan with something like over 200% of debt to GDP ratio, that's incredible. I mean, that's very bad for them. So they'll definitely have a hard time refinancing their debt in the future and actually might end up with worse terms than what they initially agreed to. So one thing I want to talk about as well is the inflation that we might see here, or the potential hyperinflation. I mean, I don't think we'll see hyperinflation in the US, which is typically defined by an increase in price of over 50% in a given period of time. But to understand hyperinflation and how it might work, you have to understand the quantity theory of money. So just give me a sec here. I'm going to put up something on the board, and I'm going to kind of explain to you how inflation is tied into the money supply. Okay, so this is the quantity theory of money formula. M represents the money supply, V represents the velocity of circulation, or you can kind of see this as the number of transactions worldwide. It's basically the estimation of how often money changes hands. Like when I buy something from the grocery store, my money is going to the owner of the grocery store and so on. And he's going to use that to pay his rent. He's going to use that to buy his own groceries, etc., etc. So that's what the velocity of circulation is. P is the price level, and Y is going to be your national income. So what we're currently seeing is M right here, the money supply going up with stimulus packages worldwide trying to help people who are going into either temporary or permanent unemployment. Okay, in the US, we're seeing like $6 trillion worth of stimulus package being sent to Americans as well as corporations. So everything else is essentially remaining constant. You're seeing output currently at zero, or at least near zero, and we're going to see it go back to its regular level in the future with an abundance of money within the economy. So we see basically the money supply going up huge, output remaining the same once we go back to normal, which is certainly going to result in some form of inflation. This also brings into the question the devaluation of certain currencies. You saw the US talk a lot about it and compare themselves to China, where the central bank in China is not independent of their government, so the government essentially gets to decide what interest rates are going to be at, or what their target interest rates are going to be at, as well as their money supply. And that helps them kind of manipulate their currency. So the US, or Trump specifically, did kind of pressure the Fed into lowering interest rates to zero. I'll put maybe a clip up on the board here, but he essentially said in a press conference he has the right to remove the chairman of the Fed, which is the central bank in the US, from power if he does not do the right thing. And obviously what the president thinks the right thing to do was to lower interest rates to zero, which is what they did. Okay, anyways, back to my point. You're seeing a huge increase in money supply worldwide right now, not just in North America, but worldwide. Output's going to go back to regular levels, or maybe just a little bit below regular levels, which is going to result in some inflation. So just comparing our current market conditions to the Great Depression, it's definitely much different, okay? So you had the roaring 20s kind of during or after the First World War, where you saw an economic boom, okay? Some of the best times in economic history in North America. Some may even consider this to the level of prosperity we saw after 2008, 2009 to the present date. You had an ensuing global crisis from the First World War. You had unemployment rising or skyrocketing 25%. You had the first major stock crash of 1929, which saw stocks fall almost as much as 80% after 3 years. The global crisis we're facing today is much different. It's a health pandemic. The lockdown is pretty much self-inflicted, but probably the right thing to do. I mean, I'm not even going to say probably. It is the right thing to do. This is much different than recovering from a world war, which is also why some people believe there is possibility of a V-shaped recovery, if you will. In conclusion, when you compare our current situation to the Great Depression, it's obviously a lot different. You can always look at the past to help you understand the future, but you can never look at the past to predict the future. History will never repeat itself, but it may rhyme. Mark Twain. We went somewhere from being 100% operational to somewhere probably between 25 to 10% operational worldwide. We have entities such as the International Monetary Fund calling for the greatest slowdown in economic history, or the greatest slowdown since the last Great Depression. Like I said, this is somewhat self-inflicted, which is why some people believe there will be a V-shaped recovery in the latter half of 2020. However, the time you may have to wait for a recovery is currently unknown, okay? So just make sure when you're picking individual companies in the stock market, you're looking for strong balance sheets, companies with a history of strong return on invested capital, and companies that you expect to survive this economic slowdown. We know that Q2 numbers are probably going to be absolutely horrible. We don't know what Q3 and Q4 are going to look like, okay? So just beware of this potential global debt crisis. Beware of this potential inflation or hyperinflation in certain countries printing an excess of money. Be sure to watch out for macro indicators such as GDP, unemployment, inflation, retail sales, as well as industrial output. And just be careful investing through 2020. We're in some volatile times. We don't know what the future is going to look like. The good news is our economy is probably in a much better situation than we were back in the Great Depression. There is potential for a V-shaped recovery, but we have no idea what Q3 and Q4 are going to look like at this point. Once again, just a disclaimer to end the video, always assess your risk tolerance. Only invest money you're willing to lose in risky companies, and just make sure that you're investing in the appropriate level of risk for your current situation. If you're not a billionaire, you probably don't want to be risking hundreds of thousands of dollars. Okay, I hope you guys enjoyed. That's the video for today. If you did enjoy, don't forget to share the video with a friend if you learned something. Like the video if you did, dislike it if you didn't like it, and subscribe to the channel if you want to see more personal finance and investing content, okay? Hope you guys enjoyed. I'll see you guys in the next video. Peace out.